This is Matt Godleski with Stewardship Financial Advisors Investment Committee, bringing you this week's snapshot edition of The Pulse. Here's what we're watching this week. Markets fall as support for the economy wanes, as virus numbers tick up with fears of more lockdowns ahead, while political wrangling in Washington adds to the risk-off tone. Equity markets continued their plunge this week, nearly erasing gains for the S&P 500 this year, led by technology stocks. The decline was broad-based, sparing very few firms from the sell-off. Fears of a renewed surge in COVID cases in Europe put investors on edge, while testimony on Capitol Hill from the Federal Reserve and U.S. Treasury reiterated the absolute need for more stimulus to keep the U.S. economy afloat. The passing of Justice Ginsburg all but eliminated hopes of any bills being passed in Congress, however, as both sides of the aisle entrenched for a bitter election over the next 2 months. Markets reacted appropriately to these negative developments, reducing risk and dimming the outlook for a continued rebound in economic activity and asset prices. Despite ongoing stronger than expected reported economic data, the U.S. economy remains well below potential, and the unemployment rate close to double digits. Some pockets of prosperity remain, particularly housing and manufacturing, but the services economy, which makes up the bulk of economic growth, is suffering from lack of demand. Even ports and railroads are seeing record volumes as stores restock and consumers continue their stay-at-home purchases, but much of that is likely a one-time bump that will fade in coming months. In fact, the more real-time, higher-frequency data is trending lower, with dissipating expectations for higher growth. Businesses continue to express that risks remain to the downside, with election fears and the virus dampening expectations. Meanwhile, economists now predict that the lack of a deal from Congress would cut economic growth by 5 percentage points in the fourth quarter of this year. This will likely lead to funding problems for states and local governments, as well as small businesses, which could result in additional layoffs and business closures. The effects of aid should not be understated, with the Fed, markets, and businesses pleading for additional aid to bridge the output gap from the lingering downturn. Given the uncertainty facing the next several weeks, we will remain defensively postured and be raising a limited amount of cash to be better prepared for volatility ahead. Equities have fallen dramatically from their highs in August, but remain positive for the year, and we are constructive on the outlook past election season. While we fully expect some big price action in the near term, we believe that trying to time this market is extremely difficult given the trifecta of unknowns: COVID's future course, the fate of fiscal stimulus out of Washington, and the determination of the next administration. Record low bond yields and ongoing liquidity from the Fed remain supportive of risk assets for the years ahead, providing enough of a tailwind for us to stay invested despite the risks. Thanks for watching, and check out our website to read the full version of The Pulse for more details.